Welcome back to the channel, guys. Nick Armenis here, and I've got an exciting video for you today. So this is going to be about my ASX buy and hold forever stocks. So these are stocks that you can buy and hold forever and feel safe that your money is going to be well invested, because these are going to be companies that are going to be around for a very long time. Now, the approach I've taken here is, I guess, loosely based on a Warren Buffett-esque approach to investing, which is buying and holding for long periods of time, and I'll give you my criteria very shortly. So I hope you enjoy this video, guys. It's going to give you a few stock pick ideas for those of you that want to buy and hold for basically ever, or for long periods of time, and you're wanting some safe investments that are continue to grow over and over through the years. So as always, I'm not a financial professional, guys. Please read my disclaimer. So in the first part of this video, I'm going to take you through my take on, I guess, Buffett's criteria and how I use it to find stocks and how to research and analyze them, okay? So I've got 5 things that I basically look for based on, I guess, Warren Buffett's teachings. So for those of you that don't know Warren Buffett, he's probably the world's best and most well-known investor, and his approach has always been to find companies that are well-priced, that have a strong moat, strong track record of delivering revenue, earnings, and share price growth, good prospects for continuing to grow, but not in a structural decline. So sometimes businesses may be growing over a short period of time, but they're in an industry that's declining. For example, fossil fuels, some would argue, are structurally declining at the moment, right? So there's more investment in renewables, less investment in fossil fuels. There's lots of businesses like that, right? So bricks and mortar retail is in decline, while e-commerce, online sales are growing. The other thing he likes to look for is a moat, so high barriers to entry, a moat which can basically be high barriers to entry or a strong brand. So it's something that protects the business from others, from entering into it or from competing with them, right? So, you know, there's lots of phone makers out there, right? So you've got Nokia, you've got Windows, you've got Apple, Android, all sorts, right? But for some reason, certain companies like Apple are able to charge much higher prices and continue to grow, right? They continue to grow year on year. Obviously, they've got other things that they're creating, not just iPhones, but their strong brand allows them to have pricing power, and their consumers love what they have, right? By the same token, so a toll road who has been given the authority to charge people to use the road, there's a high barrier to entry there because they've got exclusive access to that, right? So they own an asset where they can use exclusively. That high barrier to entry means that it's very hard for another business to come in and compete, right? You know, it's very expensive to go and build another bridge beside an existing bridge, go through government approvals, all those sort of things. So moats are something that Warren Buffett really likes. Probably the most important thing to him, I think, is a good management team. And he wants people that have, integrity and intelligence. So integrity is something within the management team that he really likes to see, because if they don't have integrity, then basically, you can't trust them. And the last one, he really likes stocks that are well priced. He won't overpay for things, but he will still buy when things are perceived to be expensive, as long as he's valued it below intrinsic value, right? So he likes to buy things below intrinsic value or as close to intrinsic value as possible. So that's my criteria, guys. Stay tuned right to the end. I'm going to show you 5 picks, basically, that I think meet this criteria or very close to meet it on the ASX. The first stock is CSL Limited, ASX ticker CSL. So what do? For those of you that don't know, CSL is one of our biggest companies in Australia. They're a global specialty biotechnology company that researches, develops, manufactures and markets products to treat and prevent serious human conditions. Now, this is a bit of a difficult company to understand, especially for beginners. But what I'm going to do is I'm going to just show you the types of things they make. But basically, they make a range of health-related biotech products in the areas of, blood plasma derivatives, vaccines, antivenom, cell structure reagents used in various medical and genetic research manufacturing applications. So they have a lot of different customers. This is a global business. They've got a huge revenue, guys, of 8.539 billion. and net income of 1.9 billion. So really big company, 25,000 employees. So just so you understand what they make, come and click on this link and just have a look at the products they make, like the vaccines, right? They've got these vaccines that they've made. And then to better understand it again is look at the two divisions. So Seqirus, I believe it's pronounced, will talk you through all the different vaccines that they own. The antivenoms, so they own the rights to a lot and produce a lot of the antivenoms we have in Australia. So for all of these different things, black snake, box jellyfish, these guys developed it. They were actually originally a government company that was listed and sold off and privatized, basically. So if you got into the IPO, you would have made a hell of a lot of money. But just so you understand, you don't exactly need to know all these things, but you need to understand the financials of the business. They've got products and they sell them, basically, and they create them, right? They spend a lot of money on research and development so they can keep on top and continue to make new products. They've got a few products that make most of their money, and that's all you really need to understand about this business. But I do recommend you come and click this link that I have in my slide and kind of start to understand a bit more about this business. So as of recording this video, it's trading at 277.50. It has dropped back a little bit, but as you can see, over a 20-30 year period, you've made a fair bit of money, even if you just buy and held. Particularly recently, right? The problem is that these little ebbs and flows here you can't see given the time frame, right? So I recommend jumping in and having a look at the chart, but it's coming up, in my view, to be a very attractive price point to buy. Potentially it has a little bit more to drop off, but this is the sort of stock that every time you wait for it to drop, it just charges along. It's got so much, pricing power, and it just continues to grow and grow. And for those of you that have sat around waiting to try and get this business and buy it, waiting for a drop, it never really comes in a big way, right? So it's definitely one to consider, guys. It's got a market cap of 126 billion. Its PE ratio is very high. So this is the one factor I think that Warren Buffett probably wouldn't like about this stock. It does pay a dividend, but it does grow quite fast too. So it's got a great track record of growing revenue, EPS, and cash flow. It's got a really strong balance sheet, high return on capital business. It's got high barriers to entry because all of these things it creates, you need to invest a lot of money to research and development, have a lot of resources to create and then market this product. And being in the medical industry, not anyone can just jump in, right? So there's high barriers to entry. It's got a very strong brand name out there in the world. One of the reasons it has suffered a little bit of late is the US dollar headwinds. These will eventually abate as they're able to put price increases in place. So when a business gets something like a US dollar issue, where the Australian dollar has appreciated and they earn a lot of US dollars, this negatively impacts them, where prior to this, they were benefiting from it. So yeah, as I said, I think an attractive price point is coming up, guys. So what I can do is I can actually take you into the balance sheet and a few of the numbers here within CommSec just to reiterate exactly what I just said here in my thesis. Okay, so we've just jumped into CommSec under financials, company historicals. Have a look at this. So since 2011, really strong increase in earnings. Return on equity has been dropping back a little bit, guys, which obviously isn't what you want to look for. But as drugs come and go, research and development is spent over time, you would expect it to be a little bit lumpy with such a business. Sales are consistently growing, as is cash flow, because, sales and earnings and stuff, guys, you can kind of manipulate a little bit, but cash flow is one that's a little bit harder to do so, and seeing that they've got very strong cash flow, which is basically, the amount of cash the business has available, net of expenses, of money coming out, so outgoings, it still keeps going up, right? Capital spending increases, right? Which I imagine some of it would have been related to the corona vaccine, so the COVID vaccine, which has they've decided to not go ahead with it with the UQ vaccine that was going to be there. So look, the PE is always quite high. At the moment, it is very high. You would expect strong earnings, or this would take a little bit of a hit. But as I said, every time you wait for this stock to get too cheap, it just bolts ahead, right? We'll quickly look at the balance sheet. So they've got 9.4 billion in current assets and 3.1 in liabilities. So their assets way more than cover their liabilities. And their cash and receivables more than covers the accounts payable, right? And anything due to banks. So as you can see, very, very solid numbers, guys. Definitely worth adding to your list. So that was CSL, guys. Next company on my list is Invocare, ASX ticker IVC. So what do? Invocare owns and operates funeral homes, cemeteries, and crematoria around Australia, New Zealand, and Singapore. That includes pet cemeteries, guys, which they're seeing some growth in. Some of the key funeral brands that you may have seen out there are White Lady Funerals, Simplicity Funerals, and Singapore Casket. IVC also operates over 290 funeral locations and 16 cemeteries and crematoria. So crematoriums and cemeteries as well. So anything to do with funerals, these guys have it covered. And I mean, what more of a business can you see of never disappearing than funeral homes, right? So as the recording the video, it's trading at 11.45, which it definitely has dropped back quite a bit, mainly due to COVID, right? So it did hit a high of 15.79, and during the COVID low of it hit a low of $9. It's got a market cap of 1.64 billion. And its PE is whacked out at the moment because of what's happening with COVID. So this is one where I would wait and see what their next earnings update, now that COVID has kind of abated a little bit in Australia, and see what they report. So obviously we're buying and holding longer term, and I don't think longer term this will have an issue, but to get a good price on this stock, I would wait and see exactly what is happening in the business, because it has entered a bit of a downtrend, and when something like that happens, it could continue to do so. So wait and see what happens, and hopefully it starts a new uptrend. They also pay a half decent dividend of 2.6%, which is a little bit low, but definitely still higher than term deposits at the moment. My investment thesis, guys, is pretty simple. This is a very simple, boring, and safe business that will always be needed, okay? I'd be very, very pressed to find a business that is more safe and boring than this. Death is inevitable. So what do they say? Death and taxes are inevitable. So this is a business that will continue to do well over time. It's able to consistently increase prices as, I guess, numbers of death increase and supply constraints within the market appear in different areas. It's the dominant player in Australia. There is another listed company, which I may cover off in the future, but these guys are by far the biggest. They mainly play to the bigger cities, and their competitor Propel plays in, I guess, more regional areas. So, I mean, if you had both of them, you got the entire Australian market covered. It was very, very heavily sold down in the last 12 months, obviously due to the COVID impacts from reduced numbers at funerals, but I believe this is going to be temporary over the long term. And less money is currently being spent due to the social distancing measures, so no one can go to the funerals, so people are opting to have more cremations, which are also lower cost, which is impacting the earnings of this business. So if you want to buy it, wait and see over the next few updates what is said. If these things are changing, this will continue to have a bright future, guys. As long as they can stay afloat, and they did a capital raising of, I believe, 200 million to bolster their balance sheet, they should be okay. But what I'll do is I will jump into ComSec quickly and take you through the numbers very briefly. So as you can see, earnings, guys, were climbing steadily, and then 2018, 2019 earnings were not quite as good. I believe in 2018 they made quite a big purchase, which impacted earnings. Return on equity is still very high, guys. So I like businesses that have a high return on equity, and this has a very, very high one. Sales are consistently growing. Cash flow is on the decline a little bit, but still growing. Earnings growing. Capital spending. So they do have to refurbish the buildings. So not as capital light as some businesses, but still, I guess the buildings they do have quite a long time frame that they can be left as is. So although they do need to refurbish, it's not all the time. But if you have a look, it has delivered strong returns most of the time, albeit in the last kind of 2 years, it has suffered a bit. But these buy and hold long-term stocks are something that we're not too worried about. I would want to keep an eye on this debt here. If this debt gets out of control, they may struggle longer term, but as long as they can keep that under control, I'm not too worried. Okay, so the next stock, guys, is Wesfarmers, ASX ticker WES. So what do? Wesfarmers is a diversified business operating in supermarkets, department stores, home improvement, and office supplies, resources, chemicals, energy, fertilizers, and industrials and safety products. So this is just some of the brands they own. Coles has been listed on its own, so technically not under this banner anymore. But guys, they've actually purchased quite a few other things between since this was created. This little slide that I found, they've actually bought Catch as well. So they've, I guess, delved into e-commerce, and they own a bunch of different businesses, guys. So a very, very diversified business, very safe, very conservative. Okay, they own things like Kmart, Target, Officeworks, Bunnings. It's a very, very good business. So at the moment, it's trading at $55.23. It's got a market cap of $62.62 billion, a PE of 36.84, and it's got a forward dividend yield of 2.82%. It's had a very, very strong run up, guys. Not necessarily a bad thing, but don't be surprised if it has a little bit of a pullback before it starts going back up into its little upwards trend that is happening right now. So very, very solid business that would be benefiting, Bunnings from the housing boom, from e-commerce, from being able to be open when a lot of things were closed during COVID, as well as Officeworks benefiting from all the COVID-related things as well, and Kmart just being a very, very good business. So yeah, highly diversified business, guys, is part of my investment thesis. It's got a long track record of delivering strong shareholder value, and it can survive any economic climate, guys. It's so diversified and owns some really good businesses, right? And I do like that they're starting to play more in e-commerce. It's a smart management team, very good management team who, have a decent amount of experience and have been able to navigate through many, many, many different cycles. So solid, stable dividend will make the stock in demand as the hunt for yield continues, right? So this dividend keeps increasing over time. People are going to want this safe stock that does also get some capital appreciation as well. So I won't go into the numbers on this one. So if it's something you do want me to delve more into, I will in the future. But the next business I want to talk to you about is Amcor, ASX ticker AMC. What do? Guys, they basically make packaging and different types of packaging. So flexible packaging, rigid packaging containers, specialty cartons and closures. Anyone that has a product, these guys make the packaging for them as to how it's packed, right? So all different types of packaging. And obviously they can then get anything you want printed on there. So the majority of sales are made to the defensive food and beverage, pharmaceutical, medical device, home and personal goods, and other consumer end markets. So very, very safe business that's earnings aren't disrupted normally because most of its sales come from these fast-moving consumer goods that are defensive and people buy regardless of the economic cycle. So it's trading at $14.31 at the moment. It has a market cap of $22.82 billion. It's got a PE of 30 and a forward dividend yield of 4.6%. Guys, this at the moment, this stock is a little bit of a weird one. It often kind of bounces around one level and then has a sharp upwards move. Now, what that tells me is that you can afford to either, if you can, hold this for very long periods of time and just collect that dividend, collect that income, pays a good dividend. If you pick these little points where, I guess, it looks to be around the $10 level here, it seems to bounce off that, go up to, $14.50, $15, and drop back down, back up. It does this frequently and has done for quite some time here. So this is a stock you could potentially trade in and out of if you weren't a buy and hold investor, but that is for another video. So it's an extremely defensive business with low share price volatility, great quality dividend, 4%-ish, almost 5%. Buyback has been approved recently, so I think it was a $150 million buyback. It can actually be a good trading stock, as I said, but be prepared for a period of little share price movement with this. You're probably more holding it for the dividend and to make sure that your money is safe because, rule number one is capital preservation, so you don't want to lose money. You do want it to appreciate, collect that dividend, but, it's a cyclical stock, and cyclical stocks do tend to do well when there's an economic recovery. The next stock I wanted to cover off, guys, is Washinton Pattinson, ASX ticker SOL. It's one of the oldest companies on the ASX. Guys, it's very, very old. The actual company originally was, I guess, a chemist in Sydney from memory. As you can see, there's the building there. It's an investment company now with a diversified portfolio of assets across a range of industries. Some people call this the Berkshire Hathaway of Australia. So these guys invest in multiple businesses, and it still has family members from the original founders in this business. The principal activities of the entities are equity investment, mining, property investment within the 5 segments, New Hope Corporation Limited, Round Oak Minerals, TPG, Brickworks, and other investing entities. So in short, they invest in companies, guys, and in businesses. Share price is currently at $27.58. It has a market cap of 6.6 billion, and the PE there is blown out a little bit. There was, I guess, some one-off things that occurred in the last year. It's had a very, very good run-up since COVID, going from $16 to $30.84. Don't be surprised if it has a little bit of a pullback, but definitely in an upwards trend, definitely a stock that over time continues to push upwards. I don't think there's a wrong time to buy this. It's a great business run very, very well. So my investment thesis, great conservative business with a very long track record. It's got a great diverse portfolio of equities and businesses such as Brickworks, TPG, big businesses. There's a bunch of other things they invest in as well. I recommend you go through their annual report to have a look. The longest dividend growth record for an ASX stock, guys, it's grown the dividend every year since 2000. So that's 21 years, if this year is as well, of dividend increases. So amazing track record there. It's got a good management team with lots of insider ownership. The Milner family still has family members in the business, which is absolutely amazing. I'll jump into CommSec and quickly take you through some of these guys just because it's such a good business. I really, really like it. All right, guys, so as you can see, earnings continue to increase. Really big increase last year, really big return on equity. But there was a once-off there that I will cover off in a video on this stock in the future. I really like this business, so I'm going to delve deeper into it for you. Sales consistently in an upwards trend, cash flow, earnings, etc. And as I said, dividend consistently increasing. Look, shares outstanding, which I like to look at too, has an increase, which is good because they're not diluting performance. They're not diluting the owner's interest, which is us, which is really, really good to see. Long-term debt is increasing, but they've made some good acquisitions of late. So guys, this is definitely one to put on your watch list. I would definitely keep an eye on it, and I will be doing a lot more videos on this in the future. Now guys, that's the end of this video. If you've enjoyed it, please like, comment, subscribe, hit that notification bell, and I'll see you in the next one.